I'm just curious how you're hedging. Are you planning to reduce exposure to the dollar in order to avoid some of the fluctuations, or are you going to double down?
So the most trying time was the second quarter last calendar year, when the dollar began to depreciate significantly against the Singapore dollar. And Singapore dollar is our reference currency. And in any event, 50% of our exposure is in Singapore dollars. So it moved, I think, almost 5 or 6% during that time. It's about 7% down year on year. But it went up a little bit in the last few days. So that just tells you that the dollar is truly, the currency you go into in times of risk. So what we tried to do then was we figured, okay, we'll hedge part of the dollar-denominated portfolio, which we did, a significant amount, I would say. And the cost was fair, was okay. But as we go along, everybody else had the same idea. People are not rotating out of US dollar-denominated assets, they were hedging for returns. And the hedging costs went up to, 2.5, 2.6%. So today, the cost of hedging doesn't make sense unless it's tactical for a shorter period of time. And so we now have to basically put in place what we will call natural hedges, which really means you have to invest in things that will give you a return that outpaces expected dollar depreciation. But, the events of the last few days reminds us that the US dollar is still, the global currency of choice, reserve. It's not just a reserve currency, it's a safe haven currency for many things that happen in geopolitics and what happens in the world. And so I think we've got a good balance, I would say. The dollar has strengthened. The policy of the Treasury Department is to have a strong dollar. So in that sense, would that change anything that we're doing? The answer is no. We'll continue to invest significantly in US and US dollar denominated assets.